Let's talk yield curves. Hi, I'm McQuillen, Assistant Vice President of the Private Wealth team here at GAMCO, and this is Investing Fundamentals. The slope of the yield curve shows the relationship between short-term and long-term rates. A positive slope is when the yield curve is upward sloping, short-term interest rates are lower than long-term rates. A negative slope, or an inverted curve, demonstrates that long-term rates are lower than short-term rates. The pitch of the curve refers to how quickly the yield curve changes across different maturities. A steep pitch indicates a large difference between short-term and long-term rates, while a flat pitch means little difference between short and long-term rates. For more on yield curves and their implications, check out part 2. So the yield curve is a snapshot of the U.S. Treasury market at a given point in time. Under normal circumstances, with the risk of uncertainty about what interest rates might do in the future, investors would typically expect a yield curve premium to buying a security further out on the maturity spectrum. Hence, the positively sloped yield curve is considered normal. The way in which the curve changes over time, both in nominal, yield, and pitch, is the reflection of Mr. Market's expectations about future economic growth, inflation, FOMC moves, among other dynamics. The spread between 2-year and 10-year yield curves, which we will call 2s and 10s, is usually thought of as a proxy for the curve in this context. However, any number of other spreads can be useful in specific contexts, like a 3 months versus 10-year, or 2 versus 30s, etc. For implications of yield curves, check out part 3. Let's apply what we just learned about yield curves. The pitch of the curve is only meaningful in a relative sense. When the spread between 2s and 10s widens, the curve is said to have steepened. If the spread narrows, it is said to have flattened. Let's do a few examples. If 2s were 4% and 10s were at 4.10%, and tomorrow they were 4.05% and 4.20% respectively, you would say that the curve steepened by 5 bips. 10 bips spread yesterday and 15 bips spread today. Conversely, if 2 stayed at 4 and the 10s went to 4.05, you would say that the curve flattened by 5 bips, as it was 10 bips spread yesterday and only 5 bips today. Thanks as always for taking the time to join us here on Gabelli TV for Investing Fundamentals. Please reach out to me or the Gabelli TV team with any topics and questions that you have, and I look forward to being back with you soon.
Miles is an assistant vice president for Gabelli Funds. This podcast is an excerpt from Gabelli TV that appeared on January 10, 2024. GAMCO is providing these links as a matter of general information. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI or 800-422-3554-914-921-5100 fax 914-921-5118 info@gabelli.com.